All right, let's jump right into this explainer and completely peel back the curtain on the real math of finance. We are leaving the hype, the panic, and the talking heads behind today. Instead, we're going to figure out the actual structural mechanics governing the global economy all the way down to your personal bank account. We're going to strip away the noise and look entirely at the hard, unforgiving numbers that dictate exactly how wealth is built, preserved, and, honestly, so often lost.
Here is our roadmap for today. We're covering the invisible bond market, price versus real value, index funds versus stocks, the optimal wealth ladder, and finally, the true cost of housing.
Starting right off with Section 1, the invisible bond market, the engine of global finance.
To figure out why the usual financial advice is frankly kind of falling apart right now, we have to look at the massive invisible machine running the show. The global bond market is sitting at an absolutely mind-boggling $130 trillion. Trillion with a T. To put that into perspective, it is significantly larger than the entire global stock market. While stocks get all the flashy headlines on TV, bonds quietly run the world. It's the instrument governments use to borrow and the mechanism that forces interest rates directly into the real economy. Now, here's the golden rule for this massive market, and it's literally a seesaw. Bond prices move exactly opposite to interest rates, period. When new rates go up, the price of older, lower-paying bonds just has to drop to compete. Imagine you're holding a bond paying a fixed $30 a year. If the government suddenly starts issuing new bonds paying $50 a year, well, nobody wants your old one, not unless you lower its price until the yield becomes competitive. This really simple seesaw math is the heartbeat of global liquidity. And this brings us to some pretty brutal math for the US right now. The government is carrying over $33 trillion in debt. For a long time, near-zero interest rates made this feel like free money, right? But as rates have normalized, the math changes drastically. Refinancing that old, cheap debt into new, high-rate bonds means we're looking at a projected $1 trillion a year just to service the interest. That's enough to easily blow past the entire defense and Medicare budgets.
Moving on to Section 2, price versus real value, the cycle of mania.
Let's talk about what happens when interest rates actually fall. Historically, it triggers total asset manias. People completely lose sight of the difference between a thing's actual underlying value and its soaring price tag. It turns into a sequential auction. It's exactly like John Maynard Keynes' famous beauty contest problem. You aren't evaluating what is actually valuable anymore. You're just evaluating what you think other people will think is valuable tomorrow. And it feels so validating right up until the music stops. And here is the brutal, unforgiving math of a crash. If you take a 78% hit, like the NASDAQ did back in 2002, you don't just need a 78% gain to recover. No, mathematically, you need a massive 355% gain just to get back to zero. To put that in perspective, it literally took investors 15 long years to break even after that. When price completely disconnects from value, the eventual recalibration destroys wealth on a staggering scale. And it's usually the people who arrived at the party last who get hurt the absolute most.
All right, Section 3, index funds versus stocks, the great debate.
So, knowing how crazy markets can get, how should we actually be investing our hard-earned money? Well, just look at Warren Buffett's legendary million-dollar bet. The absolute smartest, highest-paid hedge fund managers on the planet were completely crushed over a decade by a completely passive, frankly boring index fund. The elite guys pulled in about 36%. The boring index fund? Almost 126%. The fees alone just eat active managers alive. You don't have to pay a guy in a suit to be right. You just have to own the entire market.
And this data from Hendrik Bessembinder is a real eye-opener. It shows that almost all market wealth over the last century was generated by just 4% of stocks. Just 4%. The other 96% of companies effectively performed like ultra-boring government debt. Sure, Apple and Amazon created generational wealth, but finding them 20 years ago is nearly impossible for the average investor. Buying a broad index fund mathematically guarantees that you own that crucial 4%.
Which leads us perfectly into Section 4, the optimal wealth ladder, the sequence for building wealth.
Okay, we know index funds generally beat the crowd, but what is the absolute best, mathematically optimal sequence for deploying your money into them? Well, this right here is your literal roadmap. A lot of financial advice out there is just noise designed to sell you products. But if you skip steps here, like investing in crypto before grabbing your employer's guaranteed 100% match or before paying off toxic credit cards, it costs you compounding wealth you can never, ever recover.
Building wealth is methodical. I really want to hammer this point home. No stock, no crypto token, no real estate flip is ever going to reliably beat the guaranteed 20+% return you get by simply paying off your high-interest credit card debt. Step 3 of our ladder is completely non-negotiable. While the market might give you a historic 7 to 10% average return, carrying consumer debt mathematically bleeds you dry at double that rate. Stop trying to outinvest your bad debt and secure that guaranteed positive return first.
And finally, Section 5, the true cost of housing, the personal trap. Let's bring all this heavy macro and investing math right to your front door. A bank will confidently tell you to spend 28% of your gross income on housing. But that bank math very conveniently ignores property taxes, homeowners insurance, PMI, and basic maintenance. When you add the real numbers up, your true monthly burden can easily push past 50% of your actual take-home pay. Listen, a bank approval is not an affordability metric, it's just their maximum risk tolerance for giving you a loan. They aren't calculating your groceries, your childcare, or that roof repair you're definitely going to need. Now here is the massive mortgage rate trap that nobody warns you about. Everyone thinks, I'll just wait for lower rates. But when borrowing gets cheaper, a ton of buyers flood the market. This triggers massive bidding wars that drive the home's baseline price through the roof. So yeah, you might be waiting for a cheaper loan, but that cheaper loan ends up attached to a much, much more expensive house. Price is not a fixed target.
Plus, when you factor in the rent you burned while waiting and the built-in equity you totally missed out on, waiting is usually a massive financial loss. And this brings us to a crucial concept, the refinancing asymmetry. You can always refinance a bad, high interest rate later down the line, right? But you can never, ever lower your purchase price. You lock in that higher principal balance forever. You date the rate, but you marry the price.
If we trace this over the decades, the trend is pretty alarming. It proves that cheap interest rates haven't actually made homes more affordable. They've just inflated the underlying asset prices. Look at the ratio. Back in 1990, a typical house cost about 4 times an average salary. Fast forward to today, you're easily looking at 10 to 12 times what you earn. Affordable housing has been slowly but surely extracted from the middle class through a structural lack of supply and decades of easy money.
When we map your actual net take-home pay to realistic home prices today, the truth is a real gut punch. To safely afford a median-priced American home right now, without being totally house poor, you need a household income pushing $150,000. Making $100,000 used to be the gold standard for total financial comfort. Today, accounting for all the hidden costs, that safely caps you out at around a $234,000 home. It is a harsh reality check.
So as we wrap up this explainer, I want to leave you with one absolutely crucial question to carry into your financial life. When the entire world is rushing in, totally buying into the exact same financial narrative, are you actually looking at the evidence, or are you just looking at the crowd? Whether it's a crazy stock market, the pressure to buy a house out of your budget, or navigating the massive gravity of the bond market, don't let the herd decide your financial future. Stick to the math, follow the evidence, and build your wealth one deliberate step at a time.